Good day to everybody, and thank you to Francois for introducing me. My name is Neil Atkinson. I've been in and around the oil industry and the energy space generally for just more than 40 years now. And I'm going to go through in the next half an hour or so some of the issues which are affecting energy markets and particularly the oil market since the Russian invasion of Ukraine a year or so ago, and of course taking into account the recovery of the global economy from the pandemic and some issues I'll be raising as to how I think markets are going to look in 2023.
The first issue I'd like to discuss is the great importance of China in the world of oil demand, and this has important implications for where we're going in 2023. The chart shows the global demand growth we've seen since 2000. I thought I'd show a nice long historical path. And since 2000, China's contributed 45% of the growth in oil demand that we've seen in that 24-year period. And indeed, even as we saw falls in global demand in 2008 and 2009 during the financial crisis, and even in 2020, when global oil demand fell off the chart, literally so in this case, because I haven't shown the full extent of the fall for the world in 2020, which was down 9 million barrels a day. Even in 2020, China's oil demand grew. But as the pandemic resurged in China and as harsh lockdown measures were imposed, we saw that in 2022, China's oil demand actually fell. And this is the first time this has happened since even further back in history, though the chart shows back in 1990. So China is a very, very important component of global oil demand growth. And in 2023, what we're expecting is for China's demand to grow very strongly because the lockdown measures that China had in place through 2020, 2021, most of 2022, those measures have now been eliminated. So to all intents and purposes, the economy and activity is free to forge ahead as fast as possible. But there are grave concerns about the overall pace of growth of the Chinese economy. We were led to believe yesterday or the day before in some data that was released that GDP growth may be only 5% in 2023, which is modest by Chinese standards. If that does turn out to be the case, then of course demand for energy, and specifically oil, will be lower than some people might think. So China is very important, and we'll come back to its role in the global picture in a moment or two. The second chart I'd like to put up is on the other side of the balance, which is the challenges on the supply side of the market, and particularly in respect to Russian oil production and Russian oil exports. Now, when Russia invaded Ukraine just over a year or so ago, there was what you might describe as a herd instinct amongst analysts, a feeling that so awful was the Russian action, and so outraged was global opinion, that tough measures would be imposed very quickly and Russian oil exports would indeed fall. However, as 2022 progressed and as real data came in and as we were able to understand the market better, we were able to understand better the slower than expected political developments against Russia, what we actually saw in 2022, that total Russian oil exports, crude oil and products, actually increased year on year, not by very much, but nonetheless, they actually increased in 2022 over 2021. And that's the chart we have on the screen shows right now. Yes, we saw a fall off in crude shipments to the European Union, that is shipments at sea as opposed to pipeline. And we saw a big fall off in oil supplies from Russia to the United Kingdom and the USA. But those fall-offs to Europe and to the USA were more than offset by a big increase in Russian supplies to Turkey, to China, and in particular to India. India has for many years felt that global oil prices, global crude oil prices, were higher than they thought were reasonable. And at times, India was under the double impact of high dollar crude prices and a weak currency, which made oil very expensive for them. So for India to be able to buy Russian crude oil at a discount to Brent of as much as $40 a barrel at one point in 2022 proved to be an irresistible commercial opportunity. And therefore, India's shipments of Russian oil went up from negligible amounts in 2021 of only about 50,000 barrels a day to more than 1 million barrels a day at times during 2022. So that's been an interesting development. In 2023, I think that Russia will find more challenges to maintain higher exports to China and India and Turkey. There's only so much that those countries can absorb, and indeed EU sanctions may begin to be more effective. And of course, we have seen sanctions introduced by the European Union on Russian oil products in February of this year. Even so, we must accept that not all countries and not all companies are willing to blacklist Russia in the way that European and American companies are. And where there is demand for oil, whether that be crude oil or products, there will be customers willing to take oil from Russia. So I don't think that apocalyptic scenarios of the fall-off in Russian oil exports and production in 2023 are likely to prove to be the case. Now, a new slide now called the oil market tightens as we move through 2023. Now, there are big assumptions made in this chart, as indeed there always are for oil markets. And you obviously have to assume certain things, such as unchanged OPEC production, although it's quite likely to rise and fall as the market adjusts in 2023. But park that thought for a moment. Strong demand growth led by China. We talked a moment ago about China coming back strongly in 2023, now that the COVID restrictions have been eliminated, and particularly so in the second half of the year. But there are huge uncertainties about the health of the global economy. We saw yesterday testimony by the chairman of the Federal Reserve suggesting that economic pain through higher interest rates is not likely to end anytime soon. And at the moment, there is considerable variation by various organizations and analysts in terms of how strong oil demand growth in 2023 is going to be. And as an example of that, at one extreme, you have the OPEC Secretariat predicting that global oil demand will grow by 2.3 million barrels a day this year. And at the other extreme, you have the United States government through the Department of Energy predicting that demand will grow by 1.5 million barrels a day. And even lower than that, at meetings in London I attended during the Institute of Petroleum Week, a highly respected independent oil forecaster saw global oil demand going up by only 1.3 million barrels a day. So right there, you have a huge variation in the estimates of where the oil demand growth might be in 2023. And of course, continued uncertainty about the ability of Russia to continue to produce and export. Or my personal view is I think they will surprise us more to the upside rather than to the downside. But at the moment, our numbers would indicate that the market is likely to tighten as we move through 2023. And that would suggest that oil prices will remain higher rather than lower. Currently, we have Brent oil trading in the low 80s, the mid 80s dollars a barrel. It would suggest, based on this chart with a tightening balance, that price could rise to the 90s and possibly reach 100. But these twin uncertainties of global demand growth and the uncertainty about Russia's supply mean that we have a highly volatile outlook during 2023. Now, as we go through the year, we're looking at obviously oil supply from places other than Russia, and of course we're looking at LNG as well, which I'll come on to in a second. But the left-hand side of these two charts, which takes a slightly longer-term outlook through to about 2026, it would suggest that based on what we currently know about the likely level of supply increase from a range of important countries, On the chart, we show the US, Brazil, Canada, Guyana, Norway. Russia is included because it's still there. And other countries, what we see is that based on current knowledge, the likely increase in supply to 2026 will fall below the likely increase in demand. The gap is not huge. It's about a million, or just less than 1 million barrels a day. But even so, there is a potential gap. And the point to that is that when we'll come on to this in more detail in a moment, is in recent years, there has been, in my view, insufficient investment in the upstream oil and gas sector, particularly the oil sector. Indeed, there's been a shortfall of investment since 2015, and that chicken may come home to roost as we go to 2026 if oil demand growth does indeed remain robust. So there is a potential supply crunch. Might be too much of an exaggeration, but we certainly are in a situation where supply may struggle to match the demand growth in the next few years. And particularly, of course, as I say in my comment below the slides, if we see continued sanctions against Russia, obviously, but also against Iran and also against Venezuela. On the right-hand side of the pair of charts, LNG exports. Of course, that's been a very hot topic in the last year or so, because following the Russian invasion of Ukraine and following the cessation of a large proportion of Russia's pipeline exports to Western Europe, we have seen a big increase in shipments of LNG to Europe, particularly from the United States, which has seen something like an 80% increase in its LNG exports to Europe in the last year or so, at the expense of other markets, of course. But even so, the US has diverted huge volumes of LNG to Europe, and of course at significantly higher prices. But the point is that at the moment, based on current plans, over the next few years, the LNG export capacity, the liquefaction capacity that we see, is not expected to grow significantly unless investment decisions are taken very soon indeed. And of course, liquefaction capacity is only half of the story, because you then have to regasify the LNG when it reaches the export market. And there are big issues over whether sufficient investment will be found. Of course, we saw in the case of Germany during 2022 that when faced with a crisis, it is quite extraordinary what governments can actually achieve. And one would have thought that if the expectation is that the embargo against Russia will remain in place for some time to come, and the requirements of Europe for gas will remain very strong, that there will be a continued policy push in Europe to provide more LNG import terminals, regasification terminals, along the lines that the Germans have managed to achieve in 2022. Big oil. Now, this is a very interesting topic, because in the last few weeks, we've seen all the major oil companies. I put four of the biggest on the chart here to show what's happened to their earnings in the last year or so. We've seen a huge increase in profits for big oil. They're record profit levels, and it's likely that these will be maintained as we go through 2023. Now, of course, there is a massive political debate going on here in Europe, and of course in the United States also, about what is called unearned profits, windfall profits. What have these companies actually done to have earned such high profits? And of course, to some extent, they've done very little, because they've been buying and selling, trading oil and gas as they would normally do. And of course, their ability to influence the price levels is relatively limited. But these are undoubtedly windfall earnings. There's no question of that. And of course, there is a policy dilemma which faces many of the governments, particularly here in Europe, which are cash-strapped, which have major policy initiatives to support industrial and domestic consumers, to support them in the face of higher energy prices. There is a huge political dilemma for many of the countries in Europe and the European Union as a whole to essentially tax windfall profits. And indeed, many countries have already done so to varying degrees amongst the different countries. But it is a huge political temptation for governments to tax away so-called windfall profits. But of course, that raises an issue, which will tap into the theme I'll be showing just a second about investment. The oil and gas companies will say to us, and indeed quite rightly, that the higher profits will go, or a large proportion of those higher profits will go towards funding future investments. And that is important. That is what they're that is what they are there for, and that will be welcome. However, controversially, many of the big companies are indulging in major share buyback programs, which are obviously good for investors, and indeed investors deserve reward because for many years they invested in companies and they are entitled to get a reward. But there is again a big controversy about the balance between how these windfall profits are used. Is the balance tilted too much towards share buybacks as opposed to more investment? And that's a debate which will be ongoing. And it's important that this debate is ongoing because looking further into the future, as we look at the overall picture for investment to facilitate the energy transition, and on the right-hand side, the ongoing needs of the oil and gas industry, what we find is that investment generally in the energy sector has stalled and indeed is falling behind the requirements of the energy policies which so many governments have outlined. Now, taking the left-hand of the pair of slides first, the left-hand slide, total energy investment back in only got back to the 2015 level in 2021, and it's increased to some extent in 2022, although a proportion of that, of course, is due to inflation, higher costs of labor and materials in many parts of the energy sector. For oil and gas, on the right-hand side, following the collapse in oil prices in the middle of the last decade, we saw a major fallback in the investment levels in upstream oil and gas. And that, of course, saw another major fall in 2020 when demand for oil collapsed. And we were only seeing gradual increases since then in 2021 and 2022. The point here is that, according to the International Energy Agency, it is thought that to fulfill the objectives of net zero by 2050, if you take that as a legitimate policy objective, in line with the Paris Agreement made in 2015, total energy investment needs to be at least double the levels that we are currently seeing. So currently less than $2.5 trillion a year. It is widely believed it needs to be in excess of 5 if we are to achieve the net zero goals. So clearly there is a great deal of catching up to do, if indeed that is actually possible. But of course, as far as the oil and gas sector is concerned, ESG pressures and environmental social and governance pressures have undoubtedly played a part. We're all familiar with the debate amongst the banking sector, the financial sector generally, about investing in traditional fossil fuel projects. And those ESG pressures have undoubtedly played a part, although I think it can be said, based on meetings that I've attended in the industry recently, that there is a degree of reassessment taking place as investors realize that the ongoing need for investment in fossil fuels means that there needs to be a reassessment of how much investment should be devoted to the fossil fuel sector now. And this is a big topic, finding this mix between the needs of the here and now in fossil fuels and the ongoing needs to invest towards the achievement of the energy transition. But there's no doubt whatsoever that, however you look at it, total energy investment is falling behind the requirements of the long-term energy transition. Finally, just to put some perspective as far as renewables are concerned, because there have been several quite interesting reports published recently about this, is that as far as electricity capacity growth is concerned, in the next few years, there is no doubt that based on the investment plans that are available, that total renewables globally are going to take an enormous share, indeed a dominant share, of the growth that's expected in is expressed in terawatt hours on this chart over the period as we compare 2025 with 2020. But having said that, although renewable capacity growth will be pretty substantial, there is still going to be a big increase in supply from coal, and that is led by China and India, where economic growth, of course, remains very strong, and there is a big push to continue to improve living standards for those populations, and there is still a big push on the coal side. And of course, renewable capacity is one thing. Renewable generation is something else altogether. And of course, as we know from our experiences, wind and solar generation is, of course, not continuous. There are huge variabilities between the availability of wind power on certain days as compared to others. But the investment plans show pretty clearly that planned investments in renewables are going to be very, very strong indeed. But it does not mean, of course, that those investment levels are enough to meet the current needs of the global economy, the needs of the energy transition. I'll stop at this point for any questions or observations that there might be. If there are questions and observations today, they're very welcome. If it is preferred that questions come offline or directly to me or via Altiplano, that's also to be welcome. So thank you very much indeed for your attention, and we'll now switch back to Altiplano for the next part of the meeting. Thank you.
Okay, thank you very much, Neil, for this presentation. I would like to start with the first question, is about the mechanical inflationary effect of energy transition. This is something everyone agrees about. My question is about a kind of unresolved circular reference. Because of that, energy transition is inflationary. But on the other hand, other players, clean tech, renewables players, were part of the duration trade when interest rates were very, very low. And interest rates are moving up because of inflation, and part of that inflation is energy transition. So you can see we have a kind of unresolved circular reference. How do you see that going forward? Because inflation is not good for ESG, so energy transition, and is good for all the players who have legacy infrastructure, who have legacy production, etc. So in other words, is interest rates moving up? It's probably better for the big oil rather than for renewables or new entrants. What are your views on that? How can we solve out this unresolved circular reference?
I think that's an extremely important point. And indeed, until probably the Russian invasion of Ukraine, or maybe slightly before that, with the global economy recovering from the pandemic, inflation was not an issue which was widely discussed. We had been used over the previous 15 years, 20 years or so, to very low rates of inflation and indeed very low interest rates. The problem we have got is that because the investment requirements of the energy transition are so enormous, trillions of dollars a year for the next 25 years to hit the net zero target, if you assume that is the policy that should be followed, it is going to be a lot more complicated. And the problem we are now finding is that governments are tapped out in many parts of the world. They have spent trillions of dollars collectively on protecting industry and consumers from the worst ravages of the pandemic. They are now trying to obviously deal with the implications of the Russian invasion of Ukraine, which has raised energy costs for domestic and industrial consumers to historically high levels. So the ability of governments to invest and to fund the transition, that is going to be circumscribed in ways that we didn't expect a few years ago. Excuse me. And for governments to continue spending more and more money on the energy transition, in addition to all the other demands on them, will be inherently inflationary. There's no question of it. So this is a problem that we have not yet been able to resolve. What I think will happen over the next few years, 2 to 3 years or so, as successive COP meetings come along at the end of each year, is that there is going to be a growing realization that it will be impossible to make the investments that are required to hit targets that were made nearly 10 years ago. The Paris Agreement is 8 years old now, nearly. The net zero agenda was agreed by governments over the last 5, 6, 7 years. And I think we are going to see an adjustment to the expectations because it will prove to be impossible. Meanwhile, finally here, the very good point you made about the oil and gas companies, because of the record profits that they have made, even leaving aside any windfall taxes that are likely to be levied, and even leaving aside the impact of share buybacks, they are still in a very, very strong position to make the necessary investments that are still needed in fossil fuels. And at the same time, they're in a strong position also to make more investments in renewables and alternative energies, which they are already doing, although at a relatively low level. But they are doing it, and they will be prepared to do that if they can see a return. But at the moment, the picture has been clouded by the return of inflation, the fact that interest rates, as you suggest, are rising and are going to continue to rise. So I think there may be a reassessment of the longer-term policy goals.
Mm. Thank you, Neil. I see that Thierry is showing his hand and would like to ask a question. Thierry, can you?
Okay.
Okay, Thierry, it's up to you.
Yeah, can you hear me?
Yes.
Okay, perfect. No, just on the subject that was just discussed. Yeah, I mean, you've seen the debate about the Shell valuation, or basically the European valuation versus the US major are about half, and so 3 times cash flow versus 6 times cash flow. And there's a big debate around Shell strategy. One of the reasons why there is this discount, it seems, is because of their investments in renewable. That means that they spend much more money than the US in renewable, and their valuation is half what the US valuation are. On the other hand, pure renewable company are valued at much higher multiple, but within the oil company, it's a penalty. So how do you think they can solve that conundrum? What strategy can they adopt? You know, they could basically just either stop investing and go back to investing in fossil fuel and increase capacity and growth, or they could spin the business off. But whatever they do, it seems that there will be a penalty on one side or the other. Either we don't reach the targets in renewable, or they lose the valuation. So how do you see that strategy evolving in that context?
I'm not the best person in the world to talk about corporate strategies, but I think there's a difference between Shell and BP and maybe Chevron and Exxon in terms of Shell and BP having feet in a bigger foot in the European camp than, say, Exxon and Chevron do, although they obviously do have interest here. Shell are under much stronger shareholder pressure, as indeed are BP, than I think is the case for the US majors. And you've probably seen that Shell lost out in a legal action in the Netherlands in the last year or so about its energy transition strategies. BP is coming under that kind of pressure as well. So Shell and BP are in a very difficult situation. You may also have read that Shell considered relocating to the United States and becoming a US company, partly because of these ESG pressures. And of course, Shell now has new leadership. BP recently announced when it published its results that it was amending its targets in terms of how it transitions away from fossil fuels towards renewables. And that is as a result of pressure because compared to its peers, it was financially underperforming, and also BP has recognized the continued relevance and need for investments in fossil fuels. So I don't quite know how well that answers your question or not, but certainly in the case of Chevron and Exxon, they are unapologetically, and indeed I believe rightly, pursuing very heavy investments in the fossil fuel sector because they're needed. Shell and BP are slightly different because of their history, but I think BP are recognizing the need to cool down, if you like, the pace of their transition, and I think Shell are recognizing that as well under their new leadership.
Thank you, Neil. May I ask you another question about LNG and the trade-off between Russian gas and US LNG or Qatari LNG? How do you see the economics? Because LNG requires a lot of infrastructure investment, something you mentioned about Germany, for instance. So do you think that all the exports we have experienced recently are sustainable? And can we go higher in terms of imports in Europe from these countries if we don't invest first in infra? And how do you see the arbitrage between the price level from Russia, which is very, very low compared to these LNG imports? So there is a problem of economics in the medium term, something we need to address in terms of subsidies, in terms of something to do, or in terms of, because investments required are very, very, very huge to completely counterbalance what we have imported from Russia so far. What are your views on that?
Yeah, it's a big, big subject, and of course, we've been focused until just now, essentially, on how we get through the winter of 2022 to 2023, because of course the weather plays an enormously influential role. And in this winter heating season as a whole in Northern Europe, we've seen temperatures roughly 15% or so higher than they were a year ago and below the medium-term average. So we've been very lucky. Now, excuse me, as we move forward and we start to look to next winter, which seems sort of crazy, here we are sitting in March, but as we look to next winter, we're in a situation where the major European economies are sitting on much higher stocks of natural gas at the end of the worst of the winter season than anybody could have expected. So the ability to restock as we move through 2023 to be ready for next winter, we are in a much better position to restock than we could have thought was possible. But if you go to the medium term, which is your point, and an extremely good point, if we assume for the sake of argument that the European Union, G7, NATO, the US, bringing all these countries together under those various labels, have decided to support Ukraine to the extent of whatever it takes, we are therefore going to have to accept that supplies of Russian pipeline gas will be severely restricted for many years to come, unless there is some settlement to the war, in which case my prediction is that we would go back to Russian gas pretty quickly because it's available in huge quantities, it's at relatively low cost, and the infrastructure is already in place. But let's assume that we don't go back to Russian gas. Well, the requirement then for next winter is to restock, and that means we will be competing, European buyers will be competing against a resurgent Chinese economy, which imports large volumes of LNG. We'll be competing against the other economies of the East, such as Japan and Korea, for LNG supplies, and we are likely to see big competition. I would love to be a US LNG company right now, because they will see bidders from around the world bidding up the price of their cargoes. But that in a way is almost the easy bit on paper. The US has lots of capacity, will add some more. But the problem is that unless the policy objective we saw in 2022-3 to increase the regasification facilities in Europe, unless that is maintained, Europe is going to run into a problem, because there's only so much you can process. And those investments will continue to be needed. Floating regasification terminals, which is what the Germans have gone in for, they are going to have to be, those investments are going to have to be maintained. In the meantime, countries such as Qatar, Australia, the United States, they are adding some capacity, but not that much based on current plans, because it takes a long time to build a lot of this liquefaction capacity. And then, of course, if you're going to make the investments in liquefaction capacity, and indeed in regasification capacity, you have to have the security of long-term contracts. There have to be contracts for 10, 15, 20, 25 years ahead by people guaranteeing to buy your LNG before you will increase your investments in the facilities. So the European Union, I think, needs to take a big lead here, because Europe is such a huge market, and there needs to be some kind of cooperation and some kind of coming together to ensure that we get more LNG, but that it will continue to be bought by European customers. And that runs into, of course, the energy transition. How much gas should we be continuing to use here in Europe, compatible with the targets of net zero by 2050? And that comes back to a big policy problem here. You can't have both. You can't have the necessary security in the medium term for natural gas supplies and have your European companies signing up for 25-year contracts with potential suppliers of LNG, because that's not going to be compatible with net zero in 2050. Big problem, which is why I believe, as I said earlier on in the body of this presentation, that I think there's going to have to be some adjustment to the policy objectives of net zero by 2050.
Thank you, Neil, and that's an interesting conclusion of this webinar. So so we can take more questions if you'd like to, but if there is no further questions, I suggest we stop now. And thank you very much, Neil. Thank you for all the participants. And should you have any questions going forward about this presentation, about energy issues, please get back to us, ask the question, and we'd be very, very pleased to answer to them. Thank you very much, and have a good day.
Thank you.